Security Analysis by Benjamin Graham and David Dodd. Introduction. What if I told you there was a secret that could change your entire financial future? A secret so powerful that it turned a young man from Omaha, Nebraska, with a few $1,000s in his pocket, into one of the wealthiest people in the history of the world. This isn't a story about a get-rich-quick scheme or some magical formula. It's a story about a book. A book that was written not in our flashy, fast-paced digital age, but in the ashes of the greatest financial collapse America had ever seen, the Great Depression. Imagine the year is 1934. The world is in turmoil. The stock market had lost almost 90% of its value from its peak in 1929. People's life savings were gone. Confidence was shattered. The word investing was almost a joke. It seemed like nothing more than a gambler's game, a casino where the house always wins. Wall Street was a place of ruin and despair. And in the middle of all this chaos, two professors at Columbia University, Benjamin Graham and David Dodd, sat down and did something extraordinary. They decided to bring reason to the madness. They wrote a book, a massive, detailed roadmap called Security Analysis. It wasn't just a book, it was a declaration of independence for the intelligent individual. It sold over 1 million copies, becoming the Bible for generations of the world's most successful investors. The young man from Omaha I mentioned? That was Warren Buffett. He called this book his roadmap, the bedrock upon which he built all his investment decisions. And today, I'm going to share with you the timeless wisdom hidden within its pages. By the end of our time together, you'll understand the simple, profound difference between gambling in the stock market and truly investing. You'll have the foundational principles that can protect you from financial ruin and set you on a path to building real, lasting wealth. This isn't just about stocks and bonds, it's about a philosophy for making rational decisions in an irrational world. Book summary. Let's begin with the most important question you could ever ask about your money. When you put it into the stock market, are you investing or are you just speculating? It sounds like a simple question, but it's one that most people never truly stop to consider. And that confusion, that blurring of the lines, is where most financial disasters begin. In the wake of the 1929 crash, Graham saw that people had been treating the stock market like a giant casino, betting on tips, rumors, and the hope that prices would just keep going up forever. They weren't analyzing anything, they were just gambling. So, he drew a hard, clear line in the sand. He gave us a definition that has become the North Star for every serious investor since. He said, "An investment operation is one which, upon thorough analysis, promises safety of principal and a satisfactory return. Operations not meeting these requirements are speculative." Let's break that down, because those words are the key to everything. First, upon thorough analysis. This isn't about getting a hot tip from your uncle or seeing a stock mentioned on TV. It means doing the homework. It means looking at the numbers, understanding the business, and thinking for yourself. It means you have a reason for buying that goes deeper than just "I think it will go up." Second, promises safety of principal. This is crucial. An investor's first job is not to make money, but to not lose money. If you lose 50% of your capital, you need to make 100% just to get back to where you started. Graham believed that before you ever think about the upside, you must protect your downside. Safety doesn't mean there's zero risk. No investment is completely free of risk, but it means that the risk of permanent loss is small. And third, a satisfactory return. Notice he doesn't say a huge return or a quick return. He says satisfactory. An investment doesn't have to make you rich overnight. It just has to provide a reasonable profit for the risk you're taking. Anything, and I mean anything, that doesn't meet all three of those criteria is, in Graham's world, speculation. It's a gamble. And there's nothing wrong with speculating, as long as you know that's what you're doing and you're prepared to lose your entire stake. The danger comes when you think you're investing, but you're actually speculating. That's like walking a tightrope thinking there's a safety net below, only to find out there isn't one. So, how do we find these true investments? How do we perform this thorough analysis that promises safety? This brings us to the very heart of Graham's philosophy, and it's built on three powerful pillars. The first pillar is the idea of intrinsic value. Imagine you're looking to buy a car. You wouldn't just look at the price tag. You'd look under the hood. You'd check the mileage, the condition of the engine, the state of the tires. You'd try to figure out what the car is actually worth, separate from what the seller is asking for it. Graham tells us to do the exact same thing with a company. A stock is not just a ticker symbol on a screen, it's a tiny piece of ownership in a real business. And that business has an intrinsic value, a real underlying worth based on its assets, its earnings, and its future prospects. The market price is what people are willing to pay for it today. The intrinsic value is what it's really worth. And here's the secret. The two are often very, very different. Graham knew that you could never calculate a company's intrinsic value down to the last penny. The future is just too uncertain. But he said you don't need to. He used a wonderful analogy. It is quite possible to decide by inspection that a woman is old enough to vote without knowing her age, or that a man is heavier than he should be without knowing his exact weight. In the same way, you don't need to know if a company is worth exactly $47.53 per share. You just need to know that it's worth substantially more than the $25 it's selling for today. Your goal is not precision, but a reliable approximation. This leads us to the second, and most famous, pillar of Graham's philosophy, the margin of safety. This is perhaps the most important single concept in all of investing. It's the secret to that safety of principle we talked about. The margin of safety is simply the difference between a company's intrinsic value and the price you pay for it. If your analysis tells you a business is worth $1, but you can buy it for 50 cents, you have a 50-cent margin of safety. Why is this so critical? Because it protects you. It protects you from your own mistakes in calculation. It protects you from bad luck. It protects you from a sudden downturn in the economy or the industry. Think of it like building a bridge. If you expect the bridge to carry a maximum load of 10,000 pounds, you don't build it to hold exactly 10,000 pounds. You build it to hold 20,000 or 30,000 pounds. That extra capacity is your margin of safety. It ensures that even if your calculations are a little off, or something unexpected happens, the bridge won't collapse. For an investor, the margin of safety does the same thing. If you buy a stock with a large margin of safety, you can be wrong about a lot of things and still come out okay. The business doesn't have to perform spectacularly for you to make a satisfactory return. It just has to perform reasonably well. And if things go terribly wrong, your initial low purchase price gives you a cushion against a catastrophic loss. Buying with a margin of safety is the ultimate defense. It's what separates investing from gambling. A gambler hopes to be right. An investor prepares to be wrong. Now, you might be thinking, this all sounds great, but where do these opportunities come from? Why would a stock ever sell for so much less than it's worth? This brings us to Graham's third pillar, and it's a beautiful and powerful metaphor for understanding the entire stock market. He asks us to imagine that we are partners in a private business with a fellow named Mr. Market. Mr. Market is a very peculiar partner. Every single day, he comes to you and offers to either buy your share of the business or sell you his, and he names a price. The thing about Mr. Market is that he's a manic depressive. Some days, he's euphoric. He sees nothing but a rosy future for your business, and he offers you a ridiculously high price for your share. On other days, he's consumed by despair. He sees nothing but trouble ahead, and he offers to sell you his share for a pitifully low price. Graham's point is this: you are free to either accept Mr. Market's offer or completely ignore him. You should never, ever let his mood influence your own judgment of what the business is worth. If he shows up one day in a panic and offers you a price far below what you know the business is worth, its intrinsic value, you should happily buy his share. If he shows up in a state of wild optimism and offers you a price far above its intrinsic value, you should happily sell him your share. But if his prices don't make sense, you just ignore him and go about your day. The mistake that most people make is that they let Mr. Market become their master instead of their servant. They get excited when he's excited, and they get terrified when he's terrified. The true investor, Graham teaches, uses Mr. Market's mood swings to their advantage. They see his irrationality not as a risk, but as an opportunity. Mr. Market is there to serve you, not to guide you. His price is a starting point, not a final verdict. So, with this framework, insisting on being an investor, not a speculator, calculating intrinsic value, demanding a margin of safety, and treating the market as our servant, Mr. Market, how do we actually put this into practice? This is where Graham gets down to the nitty-gritty of thorough analysis. He tells us to be detectives, to look for clues in a company's financial statements. He spent a huge portion of security analysis walking through the balance sheet and the income statement, and while the details can be technical, the principles are beautifully simple. He started with the balance sheet. Think of a company's balance sheet as its personal net worth statement. On one side, you have everything it owns, its assets. On the other, you have everything it owes, its liabilities. The difference between the two is its net worth, or what Graham called book value. In his day, during the Great Depression, Graham found an incredible type of opportunity that became his signature. He looked for companies that were trading for less than their net working capital. Now, what does that mean? He would take a company's current assets, things like cash in the bank, accounts receivable, and inventory, and subtract all of its liabilities, including long-term debt. What was left was the company's liquidation value. It was the amount of cash the owners could walk away with if they shut the business down, sold everything, and paid off all the debts. And believe it or not, in the 1930s, he found dozens of companies where the stock price was trading for less than this liquidation value. Imagine finding a company whose stock was selling for, say, $10 million in total, but it had $15 million of net working capital on its books. It was like buying a wallet for $10 and finding $15 inside. You get the business for free, and you get a cash bonus on top of it. This was the ultimate margin of safety. Even if the business never earned another penny, you could, in theory, liquidate it and make a 50% profit. Graham loved these net-nets, as they came to be called. One of his examples was the White Motor Company. In 1931, you could buy the entire company in the stock market for about $5.2 million. But when you looked at its balance sheet, you found it had cash assets alone, after deducting all its debts, that were worth far more than that. The company was worth more dead than alive, and the market was giving it away. These opportunities are rarer today, but the principle is timeless. Always start by understanding what a business owns and what it owes. An investor who ignores the balance sheet is flying blind. After the balance sheet, Graham turned his attention to the income statement. If the balance sheet is a company's net worth, the income statement is its annual report card. It tells you how much the business earned over the past year. For most of Wall Street, then and now, the most recent earnings figure is the most important number. But Graham was deeply skeptical of this. He warned that a single year's earnings can be misleading. A company can have a great year due to some temporary good fortune, or a terrible year due to a one-time problem. To get a true picture of a company's earning power, Graham insisted on looking at the average earnings over a long period, 5, 7, or even 10 years. This smooths out the ups and downs of the business cycle and gives you a much more reliable idea of what the company can earn under normal conditions. He used the analogy of a baseball player. A player who hits .300 for a week isn't necessarily a .300 hitter. You need to look at his average over the whole season, or even several seasons, to know his true skill. He was also very wary of what he called the trend. Wall Street loves a company whose earnings are consistently going up. They will take that upward trend and project it far into the future, convincing themselves that the growth will go on forever. Graham called this one of the most dangerous fallacies in investing. An impressive trend, he warned, often looks most impressive right at the peak, just before things turn sour. He reminded us that in business, just as in nature, trees don't grow to the sky. Competition, changing tastes, and economic cycles will always act as a force of gravity. So, when you look at an income statement, don't be seduced by last year's flashy numbers or a beautiful upward trend. Be a skeptic. Be a historian. Look at the long-term average. That's a much safer anchor for your valuation. Graham also had some very interesting things to say about dividends. Today, many people think of dividends as something for retirees. Growth is what matters. But Graham saw it differently. He believed that the primary purpose of a business is to pay dividends to its owners. The earnings of a company, he argued, belong to the shareholders. If the management decides to keep those earnings and reinvest them in the business, they had better have a very good reason. They need to be confident that they can earn a high rate of return on that reinvested capital. If they can't, he said, they should give the money back to the shareholders so they can invest it elsewhere. He was suspicious of managers who built up huge piles of cash in the company's bank account. Too often, that cash ends up being wasted on foolish acquisitions or unnecessary expansion projects that benefit the ego of the CEO more than the wallets of the owners. So, when you analyze a company, don't just look at what it earns. Look at what it does with those earnings. Is it a disciplined and intelligent allocator of your capital, or is it squandering the profits that rightfully belong to you? In the end, all of this analysis, of the balance sheet, the income statement, the dividend policy, is in service of one goal: to arrive at that conservative estimate of intrinsic value, so you can see if it's selling with a sufficient margin of safety. But Graham knew that all the numbers in the world aren't enough. The final, and perhaps most important ingredient is not in the financial statements. It's in you. It's your temperament. He observed that the investor's chief problem, and even his worst enemy, is likely to be himself. Success in investing doesn't correlate with IQ. Once you're above the level of 25. Once you have ordinary intelligence, what you need is the temperament to control the urges that get other people into trouble in investing. You need discipline to do the thorough analysis in the first place. You need patience to wait for the right opportunities, which may be few and far between. And most of all, you need the courage of your convictions to act contrary to the crowd. To buy when everyone else is selling in a panic, and to sell when everyone else is euphoric. It's easy to say, but incredibly hard to do. Human beings are herd animals. We are wired to feel safe in a crowd and terrified when we're alone. But in investing, the crowd is almost always wrong at the extremes. The great money is made by being a contrarian. That's the ultimate lesson of security analysis. It's more than just a textbook on finance. It's a philosophy for thinking independently. It gives you an intellectual framework that allows you to stand apart from the emotional madness of the market, to stay grounded in reality, and to make decisions based on fact and reason, not on fear and greed. It's not a system for getting rich quick. In fact, it's a system for getting rich slow, but for getting rich surely. And in a world that is always promising shortcuts that lead off a cliff, that is a very precious gift indeed. Commentary. As we step back and reflect on the ideas in security analysis, it's astonishing how relevant they remain today, nearly a century after they were first conceived. The world has changed in ways Graham and Dodd could never have imagined. We have instant access to global information, computers that can perform complex calculations in a nanosecond, and markets that trade 24/7. And yet, the fundamental human behaviors that drive those markets, fear, greed, and the tendency to follow the herd, are exactly the same. The great illusion of the stock market, as one modern investor called it, is that it looks easy. But as Graham taught us, real investing is hard, systematic work. It requires a mindset that is fundamentally different from the one that dominates Wall Street and the financial news. The most powerful lesson, for me, is the clear and unwavering distinction between investment and speculation. It's a line that has become dangerously blurred in our modern culture. We talk about investing in everything from tech startups with no earnings to cryptocurrencies with no assets. But Graham's definition forces us to be honest with ourselves. Are we truly analyzing a business and buying it with a margin of safety? Or are we just making a bet and hoping for the best? Answering that question honestly is the first step toward financial wisdom. So, how can you start applying these powerful ideas in your own life, right now? Here are a few simple things to think about. First, change the way you think about stocks. Stop seeing them as ticker symbols or blips on a screen. Start thinking of them as what they are: fractional ownership of real businesses. The next time you hear about a company, ask yourself, is this a business I would want to own entirely? Is it a business I understand? Does it have a long history of profitability? This simple mental shift is the beginning of thinking like an investor instead of a trader. Second, practice being a contrarian in small ways. The next time the market has a bad day and everyone is panicking, don't panic with them. Instead, get curious. Ask yourself, are the great businesses of the world really worth 5% less today than they were yesterday? Use those moments of fear as an opportunity to learn, to observe how Mr. Market behaves, and to train yourself to think independently. You don't have to buy anything, just practice seeing fear as an opportunity, not a threat. And third, pick one company you admire. Maybe it's a company whose products you use every day, and do a little bit of Graham's thorough analysis. You don't need to be a Wall Street expert. Look up its financial statements online. See how much it has earned, on average, over the last 10 years. Look at its balance sheet. How much cash does it have? How much debt? Try to come up with your own rough estimate of its intrinsic value. The exercise itself, the process of thinking like a business owner, will teach you more than 100 hours of watching financial television ever could. That was a summary of security analysis by Benjamin Graham and David Dodd. We've touched on the monumental ideas today, but I'll be honest with you, a summary is like looking at a postcard of the Grand Canyon. The real magic happens when you stand on the edge yourself. The true value is in the quiet moments of reading, when a particular example or a simple phrase connects with you in a way you didn't expect. This podcast is here to help you decide if a book is worth your time. If anything we've talked about today has sparked your curiosity, I encourage you to pick up a copy. Reading it isn't just about learning formulas, it's an experience that can genuinely shape the way you think about money, risk, and your own future. You can find a link to the book in the description below. Also, if you found this journey valuable, please take a moment to like this video and subscribe to the channel. That way, you won't miss our next exploration into another life-changing book from the billionaire's bookshelf. Let's keep learning and growing together.